Hi everybody. In our last video we were working with Warner Company's short-term liabilities. We found the maturity date for each of the 3 notes that they entered into during the year. And now we're going to do some more work with these short-term liabilities. The next thing that the problems ask you to do is calculate the interest due at maturity on each of the 3 notes that they entered into during the year. So step 4, calculate interest due at maturity on the Fox note. Assume a 360-day year. And remember, our formula is PRT, principal times rate times time. This should be a review pretty much of what we went through in Chapter 3. So the Fox note was signed on May 23rd. It has a maturity, it's a 60-day note, 15%, $4,600 principal. So the calculation looks like this. Principal of $4,600 times 15% times 60 over 360 equals $115 of interest due at maturity. I'm going to have you calculate the interest due at maturity for the Spring Bank note and for the Citibank note. Please do those calculations using PRT formula. And when you finish your calculations, click back on this video and check your work. Did you calculate $400 of interest due on the Spring Bank note at maturity? That's $12,000 times 10% times 120 over 360. And on the Citibank note, it's $90 worth of interest, $8,000 times 9% times 45 over 360. The next thing we need to do is calculate the interest that must be accrued on the Citibank note as of December 31st. The other 2 notes had maturity dates within the year. And when we paid the interest, we will record a debit to interest expense. But the Citibank note will span 2 accounting periods. We borrowed the money on December 6th, and we won't pay it back with interest until January 20th. And we have a December 31st year end in between. The matching principle says that we must record all expenses in the proper time period. And we used the money for 25 days in year 1. So we're going to have to accrue 25 days worth of interest in year 1. It's the same formula. PRT, the number of days between the date we borrowed the money and December 31st is 25 days. So you do the calculations, come back and start the video again and check your work. The interest we will need to accrue on the Citibank note at December 31st is $50, calculated at $8,000 principal times 9% interest times 25 over 360 days is $50. The next step is to calculate the interest that will be recorded in year 2 on Citibank note. Remember, it's a 45-day note. Only 25 of those days was in year 1. So the remaining 20 days, we used the money in year 2. So go ahead and calculate 20 days worth of interest on the Citibank note. When you finish, start the video again and check your work. There are two ways to get this answer. First of all, we already calculated that the full interest due for the full 45 days is $90. And we calculated that the amount relating to the month of December is $50. Therefore, 90 minus 50, $40 must be incurred for the month of January in year 2. You can also solve this with the formula PRT, $8,000 times 9% times 20 over 360 does equal $40. Well, that's all for this video. When we come back, we will start writing journal entries for all of the preceding transactions.